Welcome everyone to identifying the top 3 money leaks to your P&L or on your P&L. My name is Zach Forrest. I am the Director of Business Education here at PushPress, and excited to have with me Mr. Stu Brauer from WTF Gym Talk, and he is our subject matter expert in the financial reporting that we have going on for you today.
Alrighty, guys. So if you joined us last time, we talked about the P&L. We are going to go further into the P&L. If any of you guys have taken the time between that last webinar and this one to kind of dig into it, to pull up your own QuickBooks, ask your bookkeeper for it, you might have started recognizing some things didn't add up, meaning you'll get a P&L and you look at the bottom of a month and you're like, well, shit, that shows like I should have $7,423 in my account, but I don't. What's going on here? And instead of you guys wasting time racking your brains and trying to trace every dollar, I'm going to show you some of the areas where money can be leaked out proactively, meaning where we could save money and hopefully have a better looking P&L. But then towards the end, we'll talk about where some of that money might actually be if it's not showing up in the P&L. So let's get into this. All right. P&L basics, quick little review for you guys. A profit and loss statement is a simple financial document. It's the one we generally recommend people start with the first so they can get a better overview of their company's revenue, money in, and expenses, money out, which we all know leads us with profit. Okay. These are all gross numbers, pre-taxed, but this is something if you're signing a lease, you're looking to get a loan from a bank, or you simply as an operator want to see the financial benchmark for the health of the business, this is the best place to start. Now, getting your P&L is incredibly easy. It just costs you a SaaS product fee, pretty much. You got to sign up for generally the big two, which are QuickBooks and Xero. Very easy to hook up. There are a babillion YouTubers that have made their career teaching people how to use QuickBooks and Xero. Or if you also have a bookkeeper that you pay, highly recommend, the fee you pay them should be for them to be performing the tasks of the bookkeeping services to keep your P&L on the up and up. Otherwise, it's going to be up to you. I tell people, do not purchase QuickBooks or Xero and pay for that. I think they just upped it to I think mine is now I have one of the cheapest ones. I think it just got bumped to 40, somewhere between 40 and $60.
I paid
right? I think when I started, it was like $19.99. And that was a while ago. But it is, I promise you, it is well worth the SaaS product fee, only if you are going to do your reconciliations and make sure all the transactions being imported from your bank account are actually being categorized, because that's all it is. If you see here at the top, you make money. It goes into your bank account. You sync those bank accounts up with your QuickBooks or Xero software, and it will go ahead and start categorizing things. Like you can label PushPress, and if you want that to show up on your P&L as member management software, every time PushPress takes money from you for the service, it will log it as that. And you can do that with every vendor, everything you pay. So it's only as accurate, though, as your data entry and categorizing, or you hire an outsourced bookkeeper, which is one of the first things I recommend people outsource. Now, when we start looking at ways for you guys to decrease the outflow, the expenses, and increase the profit, right? Because that's essentially the only way it is. That's the only thing we can control. Raise your hand if right now you can control the amount of money you make today, this week, or this month. You directly can control it to the dollar. And I can't see who's raising their hand, but if anyone is, they're a liar. That's not true. You cannot control how much money you're making today. If you could, we would hire you and you could tell us how to do it. What can you control to the penny? How much you spend. I can take $9.99 off everybody's expense line of their P&L today by canceling Spotify. Done. Guaranteed. I can add $60 a month to your expense line by subscribing you to QuickBooks. Expenses are the only thing you are truly in control of. You literally can control on and off, increase or decrease. Revenue, we can't. All right, we can only influence revenue. So here are 2 ways we're going to talk about today that you guys can hopefully influence your expense lines and increase your profitability. So your P&Ls look better, especially if you're going for a new lease or, going to get a loan, whatever it may be. So let's just, this is the big word, by the way, commingling. Okay. I had a story I used to give at keynotes constantly, and I had two debit cards back in the day. I banked with Bank of America. So I had a red one that was my personal, and the Bank of America, the business debit card was blue. This is not that, but you get the idea. I swear to God, for the first probably 18 months I was in business, I never touched my red debit card. Everything in my life was a write-off. I used the business account to pay for everything. Why? Because back then, I wasn't that smart of a gym owner. I was commingling my personal and my business expenses to a degree that at the time made sense as a tax strategy. My goal was to pay as little in taxes as possible in my early years. But if I would have continued that habit and that tax strategy, I would have never been able to get a loan for my first line of credit from the SBA for $10,000 when I increased my location in year 2. I would have never been able to get another loan for $1.3 million to buy a building in 2016. I would have not been credit worthy, because when you commingle all your personal expenses with your business, all that does is increase your expenses. And what happens when expenses are increased? Profit is decreased. It is an inverse relationship if revenue stays the same. So think about things right now, and they're generally things like this. Most of you guys might use your car payment. You bought a new truck or you bought a vehicle, and you write off the monthly lease or the bank payments on that vehicle as a business write-off. Fair enough. You might go to Lululemon, drop a few $100. Got some athleisure, some stuff you're going to wear to coach in. Write that off. Fair enough. You might take all the members out for a Sunday brunch because they participated in your photo shoot and you wanted to say thank you, and you drop $300, $400, $500 having a little Sunday fun day with the members. Technically, that's client entertainment. That's a write-off. These things are fine, but if you continue to do them, you are going to find yourself in a position where if a bank looks at you and says, yeah, I get it. No, you're right. You have been successfully doing $40,000 a month, but it's costing you $32,000 a month to make it. And you're like, well, yeah. I see that, but you see this and this and this and this and this. These are all, those are things technically aren't real expenses of the business. You're not going to be able to have that conversation without looking like a novice entrepreneur and small business owner. Now, this is where I'm a random redheaded dude talking to you through a screen. I'm not your CPA. You and your CPA might very specifically have a tax strategy that involves you writing off as much as humanly possible. However, if you, in the next 3 years, think you might want to borrow institutional money from a lender, private equity, or get a loan to buy a building or anything like that, you likely do not want to pursue that strategy, because it is going to make your business look like it costs too much to run. Yeah, you made 40,000, but again, if it cost you, 35 to make 40 grand, that's not looking very good to those lenders. And if you extract your personal expenses and you no longer commingle, you might be able to clean that up. So, what does that look like? When we go ahead and when I get a business to start going through a sophistication phase, right? We're no longer doing that elementary Mickey Mouse bullshit where we're writing off everything and commingling personal business. We essentially have to give the owner a salary. So we can do this in the version of like a salary, a W-2 salary, because you are still probably working in the business, and or distributions. And that's based on how you are classified with your LLC. Some of you guys might elect as an S Corp, which would allow you to avoid double taxation in a distribution salary scenario. That's not for this prezo. That's more for a conversation with your CPA. But in any factor, let's say your truck payment, the clothes at Lulu, and taking all those clients out to eat, whatever those versions are in which you're commingling these things, right? Maybe you have your Uber is on your business account, or you ran your kids' lacrosse camp, right? Your kids' lacrosse camp was $2,000 and you paid for that through the business account. Okay. Whatever commingling you're doing, take that amount of money and just pay yourself. Will you pay taxes on it? Yes. Welcome to the world of not being poor. Rich people, wealthy people, people make money. Guess what? We also pay taxes. And I'm not talking about all the the reels you've seen on Instagram where this is how Elon Musk has never paid $1 in taxes. Not the ultra wealthy. Okay. I'm talking about the regular humans, you and me. We have to pay taxes. It is a direct consequence of success within your business and paying yourself a good amount of money. So you can continue to play this commingling game for as long as you want, but eventually it's going to catch up to you. You're going to want to buy a home and they're going to want to see, cool, how much money you've been paying yourself. Well, I don't really pay myself. I don't have a real strong W-2. I pay myself $28,000 a year because you've been paying for most of your livelihood through the business and commingling. So for those of you guys looking to sophisticate the business, it is time to put on your big boy and girl pants and cut the commingling shit out. All right. These 4 reasons are the other things that when you talk to your CPA and they talk about commingling, or you to talk to your attorney about commingling, these are the big reasons they're going to tell you. I was giving you the very practical ones. There are legal and tax issues, right? If you were to get audited, I had to do a self-managed audit in 2013 because I had not been properly paying my sales and use tax. And that could have potentially opened a door where the IRS rep could have maybe looked and found some commingling that was a little shady. That could have caused me a big problem. Okay. It lowers your business credibility again. You walk into a bank and they see the commingling and they're going to recognize it like that. I mean, they will see it instantly. It is going to lower your credit worthiness or their ability to be able to see in you a potential lendee who could pay back that money reliably. Prevents accurate bookkeeping. If you have a bookkeeper and you're constantly commingling your expenses and all that between personal and business, they likely despise working for you because it makes their job incredibly hard. If you're doing the bookkeeping, it makes your job incredibly hard. And it also provides false business data. There are gyms that, they'll send me a P&L like, shucks, Stu, I'm not that profitable. I suck. I'm like, you don't suck, but you were literally paying for your kids' after school care that is $2,200 a month through the business. Like if I take that line item out, because that's not a true operating expense of the business, you're not doing bad. Oh, and if we take this, and this out, whatever commingling's happening, this is actually a decent looking business. You just need to sophisticate the way you're handling the money and pay yourself. Give yourself this kind of allowance, this salary, these distributions, and pay for the stuff you're on your own versus making the business do it. The next step, and this one is up for debate. There are CPAs who give me high fives on this and CPAs who don't like it. It all kind of depends on the risk tolerance of your CPA and how well into the gray they like to play. If anyone's in California, this is scary to them, what I'm going to talk about today, especially after the big Uber case, which actually came off the back end of, I want to say, might have been Core Power Yoga, one of the exponential brands in the fitness industry, had a ton of employees working as 1099s. That caused a huge investigation in California, looking into these small businesses that were classifying employees as 1099 contractors when they were clearly W-2 employees. And then you'll see brands like when Uber did it and Uber wanted to make everybody a 1099 and the IRS wanted to make them W-2s. So this is a hot topic in the past 10 to 15 years. Are your employees W-2s or are they 1099 contractors? Okay. Now, real quick, for those of us, just a real quick overview. With a W-2 employee, we have to pay taxes on that, right? Payroll tax is generally around 7.65% on average, depending on where you're at in the US. If they're a 1099 contractor, you do not pay that. They pay that, okay? I'll talk to you here towards the end what the biggest risk factor is with the 1099 contractors, but I just want you to take a look at this. Imagine your gym has a monthly payroll budget of $31,000 per month. That's how much you spend in payroll. On the far left, those 2 columns, name and role, that's who they are within the org chart. Their IRS classification, they're all classified as W-2 employees. Their gross pay monthly. And then to the far right is the associated payroll taxes, 7.65%. Okay, pretty standard, nothing special. However, when you actually break down what some of these trainers do and the way this particular hypothetical business works, you're able to make a really strong argument that these personal trainers should not be W-2s. Maybe they have their own LLC and you pay the LLC. They set their schedule as to when they're available to train clients, not you. You don't tell them how to train them. They're professionals. They come in, and if someone is training for downhill skiing and they have a bad back, they write the prescription and the programming for that individual. You're not directly overseeing it. There is a case to be made. And again, it just depends on how much control you have over your trainers, that some of these trainers, these personal trainers in this hypothetical scenario, could be 1099 contractors. If we reduce them down to a 1099 because we were able to go through this 20-point checklist, just go ahead and put in IRS checklist for 1099 or independent contractor, and you'll find 1,000 versions of this. You'll be able to go through and ask yourself honestly, is this person a 1099 contractor? If they are, and there's a lot of gyms that I've worked with, and truly the trainers come in, yes, they are representative of that brand, but they pass the test. They run it how they do. They even sometimes have their own equipment that they'll bring in specifically for that one client. They set their own schedules. The gym pays their LLC versus them. There's a lot of things there. Now, the second you start violating this checklist, okay, and having to answer, you're having to answer too many yeses in that column, yes, you might have a W-2 in your hands. And because that's how you want to run it, that's perfectly fine. But I have seen, and I'll use another example, instead of the trainers, let's go ahead and take a look. Let's reimagine this scenario. Let's imagine it's a scenario in which those trainers do qualify as a 1099, but also that social media manager. Any of you guys pay like $500 a month or something like that to somebody, someone to be, they're a head coach for me, but they also do social media. You do not have to pay taxes on that social media manager role. Anything that you can go to Fiverr.com, Upwork, or Gig Salad, or any of the online freelancer marketplaces and hire that person for, that's a contractor role. To be a social media manager, do they have to be in the building? Will they use your laptop or their own? Are you hiring them as a social media manager and telling them exactly what to do? Are you hiring them because, dude, I don't know shit about TikTok and I'm not sure how to install pixels on landing pages, so I'm having this person do it? There are many roles within the gym that are true by the letter of the IRS and by the interpretation of many, not all CPAs. They could be a 1099 contractor. I did this when I had for social media management, even admin. When I had my, you go ahead and take an employee and you break out their roles, one person can have multiple roles. So Coach Sally Jones is the GM. She could be paid as a W-2 because a GM, it's going to be hard for you to create a 1099 scenario as a general manager. But let's say Sally Jones was also the social media manager. You could pay that portion of her pay as a 1099 for that role. So one human can have multiple roles in the business, and each of those roles could be classified different ways. This is a legal thing to do. You just need to have a conversation with your CPA, evaluate your particular scenario, and have a very honest conversation as what are the requirements you have. And I've had people who be like, well, I was telling Jenny Brown, the social media manager, that she had to do this, and this. But honestly, if I can save almost 8% a year in what I'm paying her and funnel that back into the business, I'm trying to lean out, Stu. Fuck it. I'll let her pick this, and this. I'll go ahead and change those IRS, that checkpoints, and get more into the no column so that I can save that money. And for some of you guys who might be looking at the money like, hey, it's not that big of a deal. I don't need to save that much. I don't want to, roll the dice with the IRS. I get it. When you start getting to larger and larger payrolls, this becomes a conversation worth having, in my opinion. Now, when you go ahead and, again, we talk about gig work or freelancer work, marketing, right? When you guys, if you hire a marketing agency, do you W-2 them? No. They probably have you fill out you probably have them fill out a 1099 at the end of the year. Bookkeeping, that is 100% a 1099 service. Administrative, photography, right? You wouldn't hire a W-2 photographer. What are you going to do? You have the camera gear? Are you telling them what aperture to shoot at and what frame rate to shoot? No, you're just like, I don't know, dude, you fuck it. You know how to do it. You do it. I just want to pay you for doing the thing. Imagine like if you hired someone to paint your house. Is that a W-2 or is that a 1099? Or someone to paint a mural in the gym. Let's do that. That'd be a 1099. Why? Because you don't know how to paint a mural. You have an idea. I want it to look like this. But then they're off to the races with it. So if you have roles like that within your business, you can be saving a considerable amount of money by classifying those roles and the payment of those roles as 1099s. Again, run this by your CPA. Don't go ahead and just go ahead and do this because, the ginger on the push press webinar said to do so. Okay. But these are all things that could be, and I believe should be at least investigated to reclassify that will save you money, significant money on your payroll taxes at the end of the year. All right. Now let's just talk about a few things that are not included. So even if you proactively do these things I'm showing you to save yourself money, lowering your expenses, which increases your profitability with the same revenue, you might still look at that profit at the end of the month via P&L and be like, where is that? That's bullshit, Stu. That money's not here. It shows me there's $7,000 in profit. I don't have $7,000 lying around in my checking account. Here's where it's likely going. We just need a different financial document. There are a lot of things not covered in the P&L. Things like if you contribute money, so meaning you were short, like you weren't going to be able to make rent, so you had to take money out of your personal savings and deposit that into the business, that is considered an owner contribution. That would not show on a P&L because that's not revenue. Okay. If you had to go ahead, if you have many loan repayments, a lot of bookkeepers will not put loan repayments with the interest on your P&L. They will not also put state and federal taxes. These are all generally gross items you see on a P&L. So there's plenty of things that can offset that. But if you want to get a clearer picture as to where your money actually is, these are the two financial documents I recommend you become familiar with once you get established and get familiar with looking at your P&L. First is a cash flow statement. Okay. COH, cash on hand. That is essentially showing the liquidity of the business, how much cash you actually have on hand. This is, this is a similar example of what you might see if you pull up a QuickBooks cash flow statement. It might look a little bit different, but essentially, what cash do you have on you now? This is a cash flow statement is something that not often, but maybe asked in a lease or a loan situation. They might want to might see sometimes, a snapshot of your current dated bank account balances is enough. They don't need the nitty gritty details. But I mean, there's car dealerships, you go to an exotic car dealership, they'll require a bank statement screenshot with today's date to see that you even have enough money to even test drive their Lamborghini. So cash on hand is the next financial document I'd recommend you start familiarizing yourself with. QuickBooks and Xero and all those other ones, they have literally a report. Boom, you can produce a cash flow statement report right away. Again, it's definitely worth, in my opinion, the SaaS fees for those. But again, you could have shown profit in your business last month, but not have that money in your account. The cash flow statement would show where it is going, why it's not there. The next one is a balance sheet. Balance sheets are going to get into assets, liabilities, and then your equity in the actual business. So for example, if you have a business that brings in $500,000 a year, okay, that's in assets, okay? Resources that will provide future benefits to an owner, okay? Your equipment, your membership, whatever it may be, all this stuff I have that's going to, these are assets I have that will provide me future benefit. That's the technical legal definition of an asset. The liability is what's owed. So whenever you hear people flexing you go to a conference, a business conference, and people are like, yeah, we did 500,000 this year in revenue. Well, you could ask, like, cool. So what kind of liabilities do you have? They're like, well, we do have that EIDL loan for 1.2 million. Like, oh, okay. I get it, buddy. If I had a $1.2 million of cash, I could probably also generate $500,000 of revenue. At least I would hope so. So understanding that assets minus the liabilities equals your actual equity in the business. So let's just use that math. If you did 500,000, you had 500,000 in assets, you had $1 million in liability, your net equity is negative 500,000. That's what your ownership, which is maybe probably 100% if you're a single owner, is worth. People ever come up like, what is my net worth as an owner? Or when someone's like, oh, I own 100% of that company. That doesn't mean anything. That just means you are 100% liable for the equity in that business. And that could be a positive number or a negative number. The balance sheet is the third document I recommend you get familiar with. I think it's on a day-to-day. It's the less practical of the documents. This gets more into some bigger pictures, especially let's say, a balance sheet where it really comes in. Loans and stuff like that, they'll want to see it. It's purchases, acquisitions. So anytime I do A&M's acquisitions or mergers, maybe one gym's buying another one or they're merging, this document 100,000% is going to be brought to the forefront, even more so than the P&Ls. The P&Ls is show me, again, revenue, expenses, profit. But this is show me, what do you guys own? Like what's the equity? I'm sorry, what are the assets of this business? But then what's all the debts? What's that liability? Do you have $16,000 dollars in one credit card? And then this EIDL loan, and then this line of credit from the local bank. And you leased your Bulldog scrubber, like whatever it may be. What are all the liabilities? And that's where you really get to pop the hood of a business and see, yeah, they make money, but they're leveraged out the ass, meaning their liabilities are way, way too high. And that's where, whenever we represent like a buyer, someone who's buying a gym, if I pop the hood and I get this balance sheet, I'd be like, we're not paying a dime. We should make him pay us to take this thing because this business right here owes this amount of money. It's technically, I don't care how much money it makes. It owes this. And unless those debts are not going to transfer when you purchase this LLC, we walk. And so like it started making those conversations very interesting. But those are the two guys, cash flow statements and balance sheets, that I recommend you start familiarizing yourself with. And I believe, I want to speak too soon, but I feel okay. I believe Zach and I will be working on some additional courses within PushStart to address those specifically, similar to what we've already done with the P&L. So if you guys have questions, want to have a conversation, I'm here.
Yeah, that's a great segue right there, Stu. First off, that was phenomenal. Thank you for that breakdown and covering of those money leaks. But yeah, the next webinar is going to touch on what I call, and I did not coin this phrase, the financial scoreboard, essentially taking the P&L, the cash flow statement, and the balance sheet and looking at them holistically to get a solid picture financially of your business. And to break it down in simple terms for everybody that's listening, you can really classify the P&L as, are my business operations making money? If you have your data entry, if you have your accounting correctly, the P&L is supposed to just show you whether or not your day-to-day operations is profitable. The cash flow statement is what's going to tell you if you're taking those profits and you're actually turning it into money in the bank, right? So because there is stuff that can happen to the profits that you're generating or not generating between operations in the bank. And then the balance statement just gives an overall picture of what you own and what you owe, right? So looking at those three things in a holistic manner, I would recommend, and Stu, you're probably going to be on par with this, probably once every quarter in a holistic manner. But the P&L, you're right. The P&L and cash flow, probably monthly. The balance statement, less often. But yeah, that'll be the next webinar in this series of the financial reporting. I'm super stoked that PushPress has started reevaluating and redefining the reporting metrics and how they do reporting in the core system. I'm sure many of you guys have seen the changes that are coming down the pipeline. We are working to make sure that the information that comes out of PushPress is exactly what every gym owner needs. And I'm really excited with the changes that I see on the horizon with this. It was one of the reasons long time ago that I had actually stayed away from the product, was because I needed better financial reporting. And now that it's in the works, I'm just stoked to see it. Stu, I have a quick question. When it comes to commingling expenses, what do you think are some scenarios where you would recommend that should happen?
Sure. So my truck, I bought a 2010 F-150 when I started the gym. In the beginning, I was an outdoor personal training. Like I did workouts in a park for a summer. But then I moved it in-house. I moved into a commercial property. The truck really wasn't a business expense. I wasn't hauling stuff, or I couldn't make a good, I wasn't mowing lawns, but I used it as a write-off. It was a 500 and whatever, $50 a month payment in an insurance. I wrote all that off because I didn't know shit. However, later on, I realized, but through talking to my accountant, we wanted that as a write-off, and we just wanted to firm it up. I went and got it wrapped. So there is a sign ordinance in Charlotte, North Carolina, that I couldn't put a sign where I wanted to on my property that I leased. So I wrapped my entire truck in a logo, and I parked that thing catty corner on the corner of the street right there on our property, and let it act as a sign because they couldn't buy. So now it 100% is a business write-off, right? So to me, it's just the practicality of it. It was like, what are you fudging? And then if you are fudging, like, can it actually be? So again, are you buying from 10,000 and Lulu or Athleta, close the coaching throughout the day? Go for it. Now, did you also then take that to, State and Liberty and buy yourself a custom suit for a wedding next month and write that off? Like, knock that shit off, right? Like, it's the obvious stuff, right? It's the very obvious things. But there are some stuff too, like, technically your personal Spotify, you had that before. Now the gym uses it. You also use it. Are you really benefiting from a $9.99 write-off on your, no? And I think it just gets you in the habit of like just paying for shit, like needing to pay yourself more. So like my Netflix, my Spotify, my SaaS products personally, my Apple Plus, I never ran those through the business. There wasn't enough money that it was really saving me anything, but it just got me in the habit of paying myself. Like, hey, I like to go out to this Irish pub every Saturday. I can't claim that as client meals and entertainment every Saturday. So I need to stop doing that. Yeah. That's all. Like,
you're Irish?
Weird, right? Like, you want to buy yourself a new Garmin and you go drop $600. Like, don't use that. That's not a business expense, bro. You don't need that Garmin.
Well, what about like your personal cell phone? Yeah.
Okay. Well, my personal cell phone has never been associated as a business line. We would use Open Phone or Sidekick, which is a SaaS product. That was a business expense that would just forward to my phone. But again, what's the ratio? How many, especially in today's world, maybe it was different when I had my gym in 2010. How many of you guys actually talk on the phone? Like the total monthly minutes you spend, what percentage is business versus what percentage is personal? Promise you it's personal. Majority.
What about if your gym does not have an office, and I do the majority of the work at a home office?
Yeah, you're able to write off a percentage of your square footage. And again, you're going to want, this is where you talk to your CPA and accountant. And I saw some good questions here. Nicholas was asking questions about the amortizing PT packages. Like if someone buys $2,000 of PT packages and they're going to use that over the course of 6 months, this is where you have your CPAs earn what you pay them. We all pay $500 to $700 a year to have returns filed. Contact your CPA. This is where Zach and myself, we are not qualified to answer some of these questions, nor do you want to ask us. Don't go into a Facebook group and ask this question. Go to a professional, right? But there's some good ones in here that I'm like, hey, that's a good question. I'd love to know the answer to that too. But it's definitely not our place to provide that level. And I think that's too, we're trying to DIY so much. Like, oh, I'm going to look it up and find, what should I do with this? Like, ask the professional that you pay for this, bookkeeper or CPA.
Yeah, Nicholas, I 100% agree with Stu on this. When it comes to recording this revenue for like tax purposes and return purposes, when it comes to business operations, you may choose to recognize that revenue. And my suggestion would be on a cash basis. So only when you actually get paid.
Upfront. That one time was just a big cash recording.
For operations. And so that's an issue that many business owners have, is delineating or discerning between, hey, should I count this operationally, or how do I differentiate this when I'm ready for tax season? And that's a conversation that you guys, again, what Stu said, go to your CPA and have that discussion. They're going to best be able to help you with that. Mike, I'm going to allow you to talk here. We have he raised his hand. I'm not sure. Mike, you can unmute yourself if you'd like. If you had a question, I saw that you raised your hand, but if not, no worries.
And Nick, what you're getting into, you'll talk to your CPA, and most, whether they want to look at your numbers in a cash or what we call accrual scenario. And again, your CPA will be the best one to answer that. But that was a great question, dude.
Cool. Well, if nobody else has any questions, I guess we will call it, and I will get this recording out and send it out to anyone who wants it. If you were on the registration list, you're going to get a copy of this recording, but you'll also be able to find this in PushStart, and the link will go out in an email to everyone. And then also stay tuned for the part 3 of the financial series. Stu, awesome. Thank you for putting your email in there. If anybody needs to send Stu a question, go for it. His email is in the chat, and I'll also link that in the email that's going out. Until next time, Stu, great having you on.
Thank you,
Excellent.
sir.
And I will talk to everyone later. Yep.
Take care, guys.